Have you ever found yourself scrolling through financial news, hearing terms like quantitative easing or maybe balance sheet runoff, and just wondered what they actually mean?
Yeah.
For your wallet, your job, the whole economy.
Yeah, how can these seemingly, I guess, wonky decisions made way up in Washington, D.C. ripple through everything?
Exactly. We're diving deep into the mechanics behind that curtain today.
It's a world often wrapped up in, pretty complex jargon, but honestly, it represents incredibly powerful tools the Federal Reserve, the U.S. Central Bank, uses.
And today we're really focusing on two specific ones, right? Tools that have massively shaped the economy over the last 15 years or so?
That's right. Quantitative easing, everyone calls it QE, and its sort of counterpart, quantitative tightening, or QT, which you don't hear about quite as much, but it's just as important.
They're basically fancy ways of saying the Fed is either hugely expanding or deliberately shrinking its financial footprint, its balance sheet.
Exactly. Think of these not just as abstract theories, but as the Fed pulling its biggest financial levers, trying to stabilize things or stimulate the economy when, the usual adjustments aren't cutting it.
Right. So our mission in this deep dive, using the great sources you've pulled together, expert analyses, research papers, official Fed reports, is to really pull out the key stuff. We want to unpack QE and QT.
Understand what they are, exactly how they work, why the Fed uses them.
And crucially, what's the real-world impact on markets, businesses, us, even the government's budget?
Think of this as your shortcut, really, to getting the plumbing of modern money policy. We'll walk you through it.
Okay, let's start right at the beginning then. Unpack the basics. What exactly is quantitative easing, QE?
So at its heart, QE is what economists call a non-traditional monetary policy tool. Usually the Fed manages the economy by tweaking that very specific short-term interest rate.
The federal funds rate.
Exactly, the Fed funds rate. That's the target for what banks charge each other for overnight loans. They raise it to cool things down, lower it to speed things up.
That's their main dial, their go-to move. But sometimes they turn that dial all the way down to zero, basically.
Precisely. When the economy's in real trouble, like a major financial crisis or, a global pandemic, the Fed slashes that rate as low as it can possibly go, near 0%. That's hitting the lower bound.
And at that point, their main tool for stimulating growth through short-term rates is pretty much exhausted.
Right. They can't push short-term rates any lower, so they need a different approach, a different way to pump liquidity into the system, push down longer-term rates, and try to get the economy moving again.
And that's where QE enters the picture. So how does it actually work, and what are the nuts and bolts?
Well, the mechanism involves the Fed making really large-scale asset purchases. They go into the financial markets and buy securities, mostly from big financial institutions.
Okay, buying assets. But the key is how they pay for them. Right.
That's the crucial part. They don't use money they already have. They essentially create new bank reserves electronically to pay for these assets.
And this is the bit that always gets called printing money.
Yes, that's the common shorthand. And look, it captures the essence in a way, but it's really important to understand it's not physical cash rolling off presses. It's all digital.
Right.
When the Fed buys, say, a treasury bond from a commercial bank, it just credits that bank's account at the Fed with a bigger balance. It's like adding a number in a central banking spreadsheet.
So digital reserve creation. And what kinds of assets are they typically buying in these QE programs here in the U.S.?
Historically, it's been focused mainly on two big categories. First, U.S. Treasury securities. That's all the debt the government issues.
Yeah.
Bills, notes, bonds.
Government debt.
Right. And second, mortgage-backed securities, MBS. Specifically, the ones guaranteed by government-sponsored outfits like Fannie Mae and Freddie Mac. These basically bundle together lots of home loans.
Okay, treasuries and MBS. And when the Fed buys these from banks, what's the immediate effect on the bank's balance sheet?
Well, it swaps out an asset they were holding, that treasury bond, or MBS, for pure cash, in the form of these newly created reserves sitting in their account at the Fed.
So the banks end up holding way more cash reserves.
Exactly. It massively increases the total amount of liquidity, the amount of money sloshing around inside the banking system itself.
And the theory behind giving banks all this extra cash is?
The theory, or maybe the hope, is that with way more reserves than they actually need for regulatory reasons or daily payments, banks will be more willing and more able to lend money out.
Okay.
This flood of liquidity is meant to encourage them to make loans to businesses, to households. The ultimate goal is to spur investment, get people spending, boost economic activity when things are really sluggish and, their main interest rate tool is already maxed out near zero.
It's like giving the system a big push when it's stalled.
That's a good way to put it.
And this idea, QE, it might sound kind of new or exotic, but the U.S. has actually used it quite a bit now, hasn't it? Particularly in response to the last couple of big crises.
Oh, absolutely. Central banks have always managed their balance sheets, mainly just to make sure there's enough physical cash out there for people. But using the balance sheet as this active, huge policy tool, that really kicked off with the response to the 2007-2009 global financial crisis.
Let's maybe walk through that history a bit based on the sources. It gives a sense of the scale. It all started with QE1, right?
Yes, the first wave, QE1. It actually started in late 2008, buying some agency debt and MBS. But it got seriously ramped up in March 2009 when the crisis was, really hitting hard and the recession was deepening.
And what did that first big push involve? How much are we talking?
We're talking massive amounts. Between March 2009 and March 2010, the Fed bought, $200 billion in agency debt, Fannie Freddie stuff. A staggering $1.25 trillion in mortgage-backed securities.
Wow, $1.25 trillion in MBS alone. That was clearly aimed right at the housing market mess. Directly, trying to unfreeze that market. And on top of that, they added $300 billion in long-term Treasury debt.
That must have made the Fed a huge player in those markets overnight.
Oh, absolutely dominant. The sources say those purchases in that 1 year alone accounted for something like 22% of the entire market for those specific assets. It was a massive intervention.
Did it last long?
Well, they started to slow down the buying, taper it, in late 2009 and early 2010 as the absolute worst of the panic seemed to ease a bit.
But the economy wasn't exactly roaring back, which led to QE2.
Exactly. QE1 helped stabilize things for sure, but the recovery was just painfully slow. Businesses weren't producing much more, hiring was weak, and crucially, that Fed funds rate was still stuck near zero. So yeah, November 2010, the Fed announced round two.
And what was the focus for QE2? Still MBS?
No, this time it was different. QE2 was focused only on long-term Treasury securities. The plan was to buy $600 billion worth at a clip of about $75 billion a month. That ran through the second quarter of 2011.
So another big chunk of treasuries. But even that wasn't quite enough. We got QE3. We did. Fast forward to late 2012. The economy was growing, but still too slowly. Unemployment was stubbornly high, businesses weren't investing much, and rates were still near zero. So the Fed decided, okay, one more round of this unconventional stuff.
What did QE3 look like?
Announced September 2012, this one was a mix. $40 billion a month in agency MBS, plus another $45 billion a month in long maturity treasuries. What was interesting about QE3 was it was initially open-ended.
Meaning no set end date.
Right, no fixed total amount. The Fed said they'd keep buying based on how the economy, particularly the job market, was doing. They did keep buying for over a year before they started to gradually taper off in early 2014, finally stopping the purchases late that year.
Okay, so 3 big rounds after the financial crisis, adding trillions to the Fed's balance sheet over several years, and then 2020 hit.
Yeah. And the pandemic response just blew everything else out of the water in terms of speed and sheer size. March 2020, the global economy basically freezes. The Fed moves incredibly fast. They announced what was essentially called unlimited quantitative easing.
Unlimited. Wow, that sounds like they were truly pulling out all the stops.
They absolutely were. The goal was immediate. Prevent a total financial system collapse, keep credit flowing somehow. And over the next 2 years or so, from March 2020 to spring 2022, when they finally stopped adding assets.
How much did they create?
They effectively created about $5 trillion in new reserves to buy bonds. $5 trillion.
Good grief. How did that compare to the balance sheet size before the pandemic?
It was a monumental jump. The Fed's balance sheet was around $4 trillion in early 2020. By spring 2022, it peaked at nearly $9 trillion. Doubled it, basically.
And if you look at those charts, like the one in the CBO source showing assets and liabilities over time.
It's incredibly stark, isn't it? The line just shoots almost vertically upwards from 2020.
It really puts it in perspective. Pre-crisis 2007, it was under $1 trillion, maybe $880 billion. After QE 1, 2, and 3, it got to around $4.5 trillion by 2017. And then the pandemic QE just sends it stratospheric to near $9 trillion.
It really shows how these tools went from being, extraordinary one-off crisis responses to becoming the main playbook for dealing with the next big shock when rates are already low. The scale just keeps getting bigger.
Okay, so we've got the mechanism, create digital money, buy assets, boost reserves, and the history. But let's dig into the impact. What does all this actually do in the economy? It's supposed to achieve more than just bigger numbers in bank accounts, right?
Oh, absolutely. Much more. The intended effects are meant to ripple right through the financial markets and then into the real economy, affecting borrowing costs, business investment, hiring, the lot.
Let's start with the financial market side. The Fed steps in, buys loads of long-term treasuries or MBS. What happens next?
So the theory goes like this. The Fed buys these assets from big investors, typically banks or other large institutions. Those institutions now have cash instead of bonds.
And they don't just want to sit on cash.
Right, they need to earn a return. So they tend to recycle that cash, reinvest it into other assets that look kind of similar in terms of risk, and return to what they just sold. Often that means things like long-term corporate bonds or other types of private debt.
Ah, okay. So the Fed buying government stuff indirectly pushes investors into buying private sector debt.
That's the idea. This extra demand for corporate bonds and the like pushes up their prices. And as you know, with bonds, when the price goes up, the effective interest rate goes down.
It lowers borrowing costs for companies.
Well, exactly. It's sometimes called the portfolio balance effect. The Fed takes safe assets out, investors rebalance into slightly riskier ones, pushing those yields down.
Has anyone tried to measure that effect?
Yeah, there's research mentioned in the sources. One study suggested that for every $100 billion in treasuries the Fed bought, corporate bond yields fell by about 8 basis points right around the time of the purchase. So not enormous for just $100 billion, but these programs were trillions, so it adds up.
Okay, so QE does seem to translate into cheaper borrowing for companies.
It appears so. Lower yields mean businesses can issue new bonds, raise money at lower interest rates. It reduces their cost of capital.
And then how does that lower cost of capital flow through to the real economy, actual businesses and households?
Well, for businesses, if it's cheaper to borrow, they might be more willing to invest in big projects, new factories, better equipment, more R&D, things they might have held off on if financing was more expensive.
Makes sense.
They might also just build up bigger cash buffers, which makes them feel more secure. For households, the impact is often more direct through lower long-term rates. Mortgage rates tend to fall, making houses cheaper to buy or refinance. Car loans get cheaper. Other consumer borrowing costs can edge down too.
So the aim is really to get everyone, businesses and individuals, investing and spending more.
That's the core goal, yes. Stimulate growth, boost hiring, help the economy get back on its feet, or maybe avoid a really deep downturn in the first place. And this works best, theoretically, when the economy is operating below potential.
Meaning there's slack, idle resources, unemployed people.
Exactly. In that situation, the stimulus helps put those resources back to work, increasing actual output, actual economic activity.
But there's always the flip side. People worry about inflation.
Right. That's the big risk. If you pump all this stimulus into an economy that's already running hot, operating at or near its full capacity, well, then you're just adding more demand, chasing a limited supply of goods and services.
And that pushes prices up.
Much more likely to get inflation than real growth in that scenario. The extra demand just bids up prices rather than encouraging more production.
So the timing, the context of when QE is done seems absolutely critical to whether you get growth or just inflation.
It's hugely important. And honestly, getting that timing right, judging where the economy's potential actually is, that's one of the hardest things central bankers have to do. Get it wrong, and you get unintended consequences.
Let's dive a bit deeper into the Fed's balance sheet itself.
Uh-huh.
We know it ballooned, but what's actually on it? The CBO source had a good breakdown.
Yeah, Box 1 lays it out. On the asset side, the stuff the Fed owns, the biggest items by far, especially since all the QE, are U.S. Treasury securities. Bills, notes, bonds, even inflation-protected ones, TIPS.
Okay.
Second biggest, those agency mortgage-backed securities we talked about. Then you have smaller things like loans made through various Fed lending windows, currency swaps with other central banks, assets from repo operations.
And the other side of the ledger, the liabilities side, how those assets are funded, essentially.
Right. The liabilities show where the money came from or where it ended up. And since QE started, the absolutely dominant liability has been reserves held by banks. These are the balances commercial banks keep in their accounts at the Fed.
That wasn't always the biggest liability, was it?
Not at all. Before 2008, the biggest liability was actually physical currency in circulation, the dollar bills in your wallet and in cash registers. But QE just created such a massive volume of new reserves that it completely dwarfed the currency component.
What else is on the liability side?
You've got the Treasury's checking account, the Treasury General account, or TGA. You've got Reverse repurchase agreements, especially that big overnight reverse repo facility, the on-n RRP, which we should definitely come back to, and a few other smaller items.
So QE fundamentally shifted the liability side from being mostly physical cash to being mostly these electronic bank reserves.
Totally transformed it. If you look at Figure 1 again, the reserves line just goes vertical after 2008 and again after 2020, while currency becomes a much smaller slice of the overall pie.
Now, this shift raises an interesting point, something Box 2 in the CBO report tackles. It feels a bit counterintuitive. When the Fed buys U.S. Treasury debt, does that actually reduce the total amount of U.S. government debt out there?
Yeah, that's a really key point to grasp. And the answer, if you look at the consolidated government balance sheet, meaning you combine the Treasury and the Fed, is no, it doesn't reduce the total.
How does that work? Because the Fed is buying a Treasury bond, which is government debt.
Right. A Treasury bond held by, say, a private investor is definitely a liability of the U.S. government. When the Fed buys it, that specific bond is no longer held by the public. It's now held by the Fed, which is, part of the broader government structure.
Okay.
But to buy that bond, the Fed created bank reserves. And those bank reserves, they are also a liability of the government, specifically of the Fed. Banks hold these reserves, and crucially, since 2008, the Fed pays interest on these reserves.
So you're just swapping one type of government IOU held by the private sector, a treasury bond, for another type of government IOU held by the private sector, a bank reserve.
Exactly. The private sector, in this case the bank, held an interest-bearing liability from the Treasury. Now it holds an interest-bearing liability from the Fed. The total stock of government liabilities held outside the consolidated government remains the same. But the composition changes dramatically.
From mostly fixed-rate treasury debt to mostly variable-rate bank reserves.
Precisely. And that change in composition really matters.
Why? What are the key differences between holding treasuries and holding reserves?
Several big ones. Reserves are almost entirely held by banks, whereas treasuries are held by everyone, individuals, pension funds, foreign governments, you name it. Reserves pay a variable interest rate set by the Fed daily, tracking its policy rate. Most treasuries pay a fixed rate set when they were issued for years or even decades.
Okay.
Plus, treasuries are used everywhere as collateral in financial deals. Reserves aren't really used that way. They're mainly for settling payments between banks and meeting requirements.
And buying mortgage-backed securities adds another wrinkle, doesn't it? Something about prepayment risk.
Yeah, that's right. When the Fed holds MBS, it takes on prepayment risk from the private sector. If interest rates fall, homeowners refinance their mortgages more often. That means the principal on those mortgages gets paid back faster than expected.
Which isn't great if you're the investor holding the MBS.
No, because you get your money back exactly when rates are low, and it's hard to reinvest it profitably. When the Fed holds the MBS, that risk getting principal back early when rates are low shifts onto the government's consolidated balance sheet.
And this big shift overall towards liabilities like reserves that pay a variable rate set by the Fed. What does that mean for the government's borrowing costs?
It makes the government's total interest expense much more sensitive to changes in the Fed's own policy rate. When the Fed raises short-term rates, the interest it pays on those trillions in reserves goes up almost instantly. That directly increases the cost of funding that huge chunk of the balance sheet.
Which brings us to how all this hits the federal budget, specifically those payments the Fed makes to the Treasury, the remittances.
Right. So the Fed earns income, mainly interest on all those treasuries and MBS it bought, and it has expenses, mainly the interest it pays out on bank reserves and also on those reverse repos, the RRPs. Remittances are just the difference. The Fed's net income, earnings minus expenses. By law, any profit the Fed makes gets sent back to the U.S. Treasury. It's not a policy goal for the Fed, just a consequence of its operations.
So how does QE affect those payments to the Treasury?
It really boils down to this spread the difference between the average interest rate the Fed earns on its assets and the average rate it pays on its liabilities, like reserves.
So if the rate earned is higher than the rate paid?
Then doing QE, which expands both assets and liabilities, increases the Fed's net income, because it's earning more on the new assets than it's paying on the new liabilities it created. This means bigger profits and bigger remittances flow to the Treasury.
And that's exactly what happened for years after the 2008 crisis and again after the 2020 pandemic kicked off, right? Because the Fed had cut the rate it pays on reserves to basically zero.
Precisely. With the interest paid on reserves near zero, the Fed was earning quite a bit on its portfolio of longer-term treasuries and MBS. The CVO charts, figures 4 and 5, show this really clearly. Remittances jumped up, averaging maybe $90 billion a year between 2010 and 2016. They hit over $100 billion in fiscal year 2021. The CBO was even projecting a peak of $111 billion for FY 2023 based on data from late 2022.
But, there's the big but. What happens when the Fed starts raising the interest rate it pays on reserves?
Yeah.
Especially if it raises it above the average rate it's earning on its older assets.
That's when the whole situation flips. And that's exactly what started happening in 2022 when the Fed began hiking rates aggressively to fight inflation. The rate paid on reserves shot up, driving the Fed's expenses way up.
But the income from their existing bond portfolio didn't rise as fast.
No, because much of that portfolio was bought when rates were low, locking in those lower yields for years. So the spread collapsed and even turned negative. Expenses started exceeding income.
And when the Fed loses money,
When its net income goes negative, it stops sending remittances to the Treasury altogether. And it records something called a deferred asset on its balance sheet. It's basically an accounting entry, an IOU representing future profits that will be needed to cover the loss before remittances can restart.
so that sharp drop in projected remittances we saw in the CDO forecast for 2023 and 2024 was entirely because of rising interest payments on reserves wiping out the Fed's profits.
Exactly. The surge in the Fed's interest expenses was expected to push remittances down dramatically, potentially suspending them for a while. Now, this deferred asset thing doesn't mean the Fed is broke or can't do its job, but it does represent a real cost to the Treasury over time. And, it could potentially affect how people perceive the Fed's finances or independence.
So the overall budget impact of QE is really complex then. It might cut the deficit short term when rates are zero.
Right, because remittances are high.
But long term, especially as rates rise, the effect is much less certain and could even add to the deficit because of those higher interest payments on reserves.
That's the tricky trade-off. The CBO basically concluded that QE likely helped reduce deficits initially when the economy was weak and rates were pinned at zero, but the long-run effect, much more uncertain and potentially turning negative as rates normalized or went higher.
Okay, that's a thorough look at the easing side expanding the balance sheet. Let's pivot now to the other direction. Quantitative tightening, or QT. What is that, simply?
QT is basically the reverse process. It's the Fed deliberately shrinking the size of its balance sheet after a period of QE expansion.
How do they actually shrink it? Do they just sell off all those bonds they bought?
They could sell assets, but that's generally seen as more disruptive to markets.
Yeah.
The main method they've used recently is what's called balance sheet runoff, or passive runoff.
Runoff. How does that work?
It's actually pretty simple. When the assets the Fed holds, say, a Treasury bond, reach their maturity date, the Treasury pays the principal back to the Fed. Instead of taking that principal payment and reinvesting it into a new bond, like they normally would to keep the balance sheet stable.
They just let the cash disappear.
Exactly. The Fed just lets that principal payment effectively extinguish. The asset disappears from the Fed's balance sheet, and the corresponding liability, usually bank reserves, also disappears from the system. So the balance sheet shrinks passively as assets mature.
Okay, so runoff is the main tool. What's the goal of QT? Why undo all that expansion?
Well, it's the mirror image of QE's goals.
Yeah.
If QE provides stimulus and liquidity, QT removes that stimulus, that accommodation. It's a way to tighten monetary policy, drain some of the excess reserves and liquidity out of the financial system, and help fight inflation, especially demand-driven inflation.
And the Fed has done this before, right? After the QE rounds following the 2008 crisis.
Yes, they did. They ran a QT program starting in late 2017 and continued it until the middle of 2019. That was really the first large-scale experiment with QT.
And then the most recent episode started after the pandemic QE.
That's right. The Fed stopped buying assets in early 2022, and then they kicked off the current QT program in June 2022. It was a key part of their overall strategy to tighten policy, alongside aggressively hiking the Fed funds rate.
What kind of pace did they set for this runoff? How quickly were they shrinking the balance sheet?
They phased it in. Initially, for the first 3 months, starting June 2022, they allowed up to $30 billion in treasuries and $17.5 billion in MBS to roll off each month. Then they ramped up to the maximum planned pace, $60 billion a month for treasuries and $35 billion a month for MBS.
So potentially up to $95 billion shrinking each month.
That was the maximum cap, yes.
Did they stick to that pace?
Mostly yes, for quite a while. However, as one of the recent sources pointed out, the May 2024 update, The Fed actually decided to slow things down a bit starting in June 2024.
Oh, how so?
They specifically reduced the monthly runoff cap for Treasuries from $60 billion down to $25 billion. The cap for MBS runoff stayed the same at $35 billion. So the overall maximum pace of shrinkage slowed, driven by less Treasury runoff.
Interesting. So how much has the balance sheet actually come down from its peak with this QT program?
Well, it peaked near $9 trillion back in spring 2022. According to the source info, by early May 2025, it had declined to around $7.4 trillion.
So a reduction of over $1.5 trillion so far.
Roughly, yes. Significant, but still leaving the balance sheet much, much larger than it was pre-crisis.
Thinking back on this tightening cycle, there was that brief, weird moment in March 2023 during the banking stress where the balance sheet actually went up for a bit, wasn't there?
Yes, that was a really important episode. It highlighted how the Fed has to balance tightening policy with maintaining financial stability. The CME Group source talks about this.
What happened?
Well, a few banks got into trouble, partly because the Fed's rapid rate hikes had caused the market value of the longer-term bonds they owned to plummet. They had these big, unrealized losses.
Right.
So the Fed quickly rolled out a new emergency lending program, the Bank Term Funding Program, or BTFP. This let banks pledge those underwater bonds as collateral to the Fed, but crucially, they could pledge them at their original face value, not their depressed market value.
So the Fed was lending against them at full value even though they were worth less.
Exactly. It was a way to inject liquidity quickly and stop the panic from spreading. And because banks borrowed quite heavily from the BTFP, nearly $500 billion at its peak, the Fed's balance sheet actually ticked up temporarily.
Even while QT was supposedly happening elsewhere.
Right. It showed they could provide targeted liquidity to stressed parts of the system to prevent a crisis, even while the overall stance was still towards tightening via QT runoff, a temporary offset.
Fascinating how they had to juggle those goals. Okay, back to the general impact of QT. We know QE lowers rates and stimulates. What does QT do?
Generally, it does the opposite, though maybe not perfectly symmetrically, which is an interesting point we should get to.
Okay, so effect on markets and interest rates first.
QT removes liquidity. It forces the private market to absorb more Treasury and MBS supply than it otherwise would have. Both factors tend to put upward pressure on longer-term interest rates. Yields need to be a bit higher to attract buyers for that extra supply.
Does it affect the yield curve?
It can, yeah. It might contribute to a steeper yield curve. And as we saw in 2019, if QT goes too far and reserves get too scarce, it can definitely cause volatility and spikes in very short-term funding rates, like repo rates.
Has research measured the impact of QT on rates, like they did for QE?
Yes, and interestingly, the effect seems smaller. The NBER paper mentions studies finding that QT announcements and the actual runoff have had a statistically significant but relatively small upward impact on government bond yields, maybe in the range of 4 to 8 basis points, especially for longer maturities.
Huh. Only 4 to 8 basis points. That seems much smaller than the impact estimated for QE announcements.
It does, and that hints at that asymmetry issue. It also probably depends on how QT is done. The current passive runoff method is likely much gentler than if the Fed were actively selling large amounts of bonds back into the market. That would probably have a bigger impact.
Okay, so QT pushes rates up modestly.
Yeah.
How does that feed into the real economy?
Higher long-term rates make borrowing more expensive. For businesses, that means the cost of financing new investments goes up, which tends to dampen their spending on expansion or new projects.
And for households.
Same story. Higher rates mean more expensive mortgages, which cools housing demand. Auto loans cost more, hitting car sales. Other forms of credit become pricier, so it tends to reduce consumer spending, especially on big-ticket durable goods.
So QT acts like a brake on economic growth.
That's the intention, yes. By making borrowing costlier and slowing down investment and consumption, QT helps cool off the economy. This slowdown, in turn, helps to bring down inflationary pressures, especially if inflation is being driven by too much demand.
So it works alongside interest rate hikes to fight inflation.
Exactly. It complements rate hikes. By draining liquidity and pushing up long-term rates, QT might mean the Fed doesn't have to raise the short-term Fed funds rate quite as high as it otherwise would to achieve the same amount of cooling. It also tends to strengthen the dollar, which can make U.S. exports a bit more expensive abroad.
And the impact on the federal budget, is that just the reverse of QE too?
It's similarly complex. As we talked about, higher rates paid on reserves during QT can slash or eliminate Fed remittances to the Treasury, or even cause the Fed to book those deferred assets due to negative income.
Right.
Beyond that, higher interest rates across the board mean the Treasury itself faces higher borrowing costs when it issues new debt. And slower economic growth generally means lower tax receipts for the government. So the net budgetary effect of QT is pretty murky, depending on how all these different factors play out.
Okay, this brings us right to that asymmetry puzzle you mentioned. The Waller speech and the NBER paper both dig into this idea. Why isn't QT just QE in reverse? Why don't the effects seem to cancel out neatly?
Yeah, it's a really interesting observation. The data seems to show that when the Fed announced QE, especially the early rounds, market yields dropped quite significantly. But when they announced QT, the upward reaction in yields seemed much, much smaller.
Which is weird, right? If adding $1 trillion in assets pushes yields down by X, shouldn't removing $1 trillion push them back up by roughly X?
You'd think so intuitively. But the main explanation offered in the sources centers on the vastly different conditions under which QE and QT happen.
How so?
QE typically gets launched in the middle of a crisis. Financial markets are seizing up, liquidity has vanished, fear is high, and rates are already near zero. In that environment, the Fed stepping in as a huge committed buyer has an outsized calming effect and impact on yields.
Okay, QE is for emergencies. And QT?
QT usually happens when things are much better. The economy is recovering, markets are functioning more normally, maybe even getting a bit frothy, and the Fed is often already raising short-term rates anyway. The crisis conditions just aren't there.
So the starting point is completely different.
Completely. Governor Waller used that great analogy in his speech.
The house fire analogy.
Exactly. If your house is on fire, that's the crisis, spraying tons of water on it, that's QE, has a massive, immediate, positive effect. It puts out the fire. Huge benefit. But later, once the fire's out and the house is safe, draining away all that water, that's QT, doesn't suddenly make the house catch fire again. The initial huge benefit of QE isn't undone just because you remove the liquidity later under normal conditions.
That makes a lot of sense, actually. The context, the level of market stress when QE happens, is why its announcement effect is so much bigger.
That seems to be the prevailing view. And the conclusion drawn is pretty interesting. This asymmetry doesn't mean QT is ineffective. It might actually suggest central banks have timed QE pretty well using it during crises when it has the biggest bang for the buck. The net effect is likely positive for stability, even if the announcement impacts aren't symmetrical.
So success isn't about perfect symmetry. It's about the overall outcome of stabilizing the economy over the cycle.
Got it. Okay, let's shift again. Let's talk about ending QT.
Yeah.
How does the Fed know when to stop shrinking the balance sheet? What are they aiming for?
Their stated goal is to stop the runoff process when the banking system reaches a state of having ample reserves. Ample reserves. That still sounds a bit fuzzy. What does it mean in practice? How much is ample?
It basically means having enough reserves circulating in the banking system so that the Fed can effectively control its main policy rate, the Fed funds rate, without causing a lot of unnecessary volatility in money markets.
They want it to run smoothly.
Right. In an ample reserve system, small day-to-day shifts in reserve supply or demand don't cause big swings in overnight rates. They definitely want to avoid a repeat of September 2019.
The repo market spiked during the last QT cycle.
Exactly. Back then, reserves unexpectedly dipped too low, and overnight borrowing rates in the critical repo market just shot up. That was a clear signal they'd gone too far, that reserves weren't ample anymore.
So how do they figure out where that ample level is before things blow up like in 2019? It must be hard to pinpoint an exact number.
It is really tricky, and they don't rely on just one number. They watch a whole dashboard of indicators. They keep a very close eye on short-term money market rates, especially in the repo market.
What are they looking for there?
If repo rates start consistently trading well above the interest rate the Fed pays on reserves, or above the rate offered at its standing repo facility, and especially if banks seem hesitant to lend reserves even when rates are attractive, that's a sign reserves might be getting scarce from the bank's point of view.
Are there other clues they watch?
Yeah, the Brookings source mentioned looking at payment flows, like in the FedWire system that handles big payments between banks. Research suggests that when banks start getting low on reserves, they might begin delaying sending payments out, especially later in the day, as they manage their balances more carefully.
Like holding onto their cash longer.
Sort of, yeah. So seeing widespread payment delays could be another signal of increasing reserve scarcity.
And they have internal technical measures too.
They do. For instance, the New York Fed developed something called a reserve demand elasticity measure. It tries to gauge how sensitive the actual Fed funds rate is to small changes in the total amount of reserves. If that measure shows rates are becoming highly sensitive, it suggests reserves are probably getting close to that ample but not necessarily abundant level.
Have any of the sources put rough dollar figures on what ample might mean?
There are estimates out there, but they vary because it's not a fixed point. Some analysts talk about reserves maybe settling somewhere between 10% and 12% of nominal GDP.
Which translates to?
Based on late 2023 GDP, that would be roughly $2.7 trillion to $3.4 trillion in reserves. Governor Waller mentioned maybe 10% to 11% of GDP as a ballpark. And a survey of the big bond dealers back in late 2023 found their median guess was reserves might end up around $3 trillion by the end of 2025.
So somewhere in the low trillions, maybe around $3 trillion seems like a common estimate. Where are reserves currently?
Well, as of late 2024, the New York Fed was still describing reserves as abundant, even though they'd come down a lot from the peak. So that suggests there was still room for QT to continue before hitting that truly ample zone.
And given the recent slowdown in the QT pace, when do they now expect to actually stop the runoff?
The Brookings analysis, factoring in that slower Treasury runoff starting in mid-2024, suggested the Fed would probably reach the point of stopping QT sometime in late 2024 or maybe early 2025. Slowing it down just stretches the process out a bit longer.
Okay. Now, this whole discussion about reserves and liquidity brings up another Fed tool that's related but different. The Overnight Reverse Repo Facility, the ONRRP. What's that about?
Yes, the ONRRP. It's a really important piece of the plumbing, especially now. This is a facility where the Fed interacts with institutions that aren't traditional banks. Think big money market funds, government-sponsored enterprises like Fannie and Freddie, primary dealers.
Okay, so non-banks. What do they do at this facility?
They can essentially deposit their excess cash with the Fed overnight. The Fed takes their cash and gives them a Treasury security as collateral for the night.
Why is this facility important, especially in the context of QT?
It serves a couple of key purposes. First, it helps the Fed control short-term interest rates. By offering a specific interest rate on these overnight reverse repos, the ONRRP acts as a floor for rates in the broader money market. These non-bank firms won't lend their cash out for less than they can get risk-free from the Fed at the ONRRP.
So it puts a bottom boundary on short-term rates.
Exactly. But second, and really relevant for QT, the amount of money parked in the ONRRP tells us something about overall liquidity in the system.
How so?
Well, the money deposited in the ONRRP is a liability on the Fed's balance sheet, just like bank reserves are. When the Fed did QE, all that liquidity it created flowed out. Some ended up as bank reserves, but a lot also ended up with these non-bank firms who then parked it at the ONRRP.
So a high balance in the ONRRP means there's still a lot of excess cash sloshing around outside the banks themselves.
Precisely. For a long time, the ONRRP balance was huge. Governor Waller mentioned it being over $500 billion, and it's been much higher at times. A large balance there signals that there's still plenty of excess liquidity in the wider financial system, not just sitting in bank reserve accounts.
And that means the Fed probably has more room to continue QT, draining reserves, before banks start feeling squeezed.
That's the thinking. As QT proceeds, both bank reserves and the ONRRP balance tend to decline as that excess liquidity gets absorbed. Watching the ONRRP balance drain down is another key indicator for policymakers trying to judge how close the system is to needing a certain level of bank reserves. It's like an overflow valve for liquidity.
Okay, that clarifies the role of the ONRRP. So we've covered a ton. The how and why of QE and QT, the history, the impacts, the balance sheet nitty-gritty, that asymmetry puzzle, how they figure out when to stop QT. Using tools this massive, tools that weren't really standard before 2008, must come with some significant risks, right?
Oh, absolutely. I mean, there are the standard risks of any monetary policy, like, misjudging the economy, doing too much stimulus and getting inflation, or doing too little and getting a recession. But these balance sheet tools add some unique layers of risk on top of that.
What are some of those specific risks tied to QE and QT?
Well, one we touched on is that increased sensitivity of government borrowing costs to short-term rate changes. With so much government debt effectively funded by variable rate reserves, Fed rate hikes hit the government's interest bill much faster and harder than they used to.
Okay, that's one. What else?
There's the risk of the Fed itself taking losses, having negative net income. If the interest it pays on reserves goes way above what it earns on its older bonds, remittances stop, and it records that deferred asset.
Does that actually impede the Fed?
Mechanically, no. The CBO says it shouldn't stop them from setting policy, but, optically, politically,
Yeah.
it could raise questions about the Fed's finances or independence, which isn't ideal. It could potentially affect how people think about future policy or inflation.
And then there's the risk of just breaking something in the markets during QT, like that 2019 repo scare.
That's a huge one for policymakers. Pulling liquidity out is inherently riskier than putting it in, maybe. If they shrink the balance sheet too fast, or if reserves get distributed unevenly among banks, you can get sudden jams in crucial funding markets like repo. Rates spike, panic can set in.
Have they done things to mitigate that risk since 2019?
Yes, definitely. The sources mention the Fed learned lessons. They now have a standing repo facility, SRF. It acts as a permanent backstop, allowing banks to borrow reserves easily if needed, which should help prevent those extreme spikes. And the whole gradual, phased approach to runoff, plus the recent slowdown, is also designed to avoid shocking the system.
So managing QT is this really delicate dance. Drain enough liquidity to tighten policy, but not so much or so fast that you cause financial instability.
It's a very careful calibration. It requires constant monitoring, constant vigilance, and being ready to adjust course like they did with the BTFP or the slower runoff pace.
Okay, last big topic, looking ahead. Once this QT cycle eventually ends and the Fed finds that ample reserves sweet spot, what does the Fed's balance sheet look like in the long run? Do they want to keep it this big forever?
Well, the goal isn't to go back to the tiny pre-2008 size. That was mostly just driven by demand for physical cash. They want a balance sheet that's smaller than the $9 trillion peak, for sure, but still large enough to maintain that ample reserve system for setting interest rates.
Are they thinking about changing the types of assets they hold in that future normalized state?
Yes, there's definitely discussion about the long-run composition. Governor Waller talked about this. One clear preference seems to be getting the Fed's holdings of those agency mortgage-backed securities down to zero eventually.
Zero MBS.
How long would that take? It'll probably take quite a while. Because mortgage rates were so low for so long, people aren't refinancing or prepaying those underlying mortgages very quickly right now. So the MBS the Fed holds are just running off very slowly through their scheduled principal payments and maturities. It's likely a multi-year, maybe even decade-long process.
Okay, so eventually an all-treasury portfolio. What about the treasuries themselves? Any change plan there?
Waller also suggested a potential shift in the maturity of those treasury holdings. He expressed a preference for the Fed eventually holding a much larger share of short-term treasury securities, like treasury bills, compared to now.
More T-bills. Why? Didn't they mostly hold bills before 2008?
They did. Before the crisis, bills were maybe a third of the Fed's portfolio. Now it's tiny, like less than 5% of their treasury holdings, under 3% of total securities.
So why go back towards holding more short-term stuff?
A couple of reasons mentioned. One is just better matching the Fed's income and expenses. If they hold more short-term bills, the interest they earn will go up and down more closely with the policy rate they set, which affects the interest they pay on reserves.
So it might reduce those big swings in net income and remittances when rates change? Less risk of those deferred assets?
Potentially, yes. It aligns income and expenses better. Another reason is flexibility for the future.
How so?
If, heaven forbid, they need to do QE again someday, starting with a portfolio full of short-term bills gives them more room to maneuver. As those bills mature quickly, that natural runoff could offset some of the new bond buying needed for stimulus. It might limit how much the balance sheet has to expand overall compared to starting with only long-term bonds that barely mature.
Interesting. So more flexibility in both tightening and potential future easing cycles.
That seems to be the thinking. It gives them more levers to manage the size and impact of the balance sheet over time.
So the long-term vision seems to be smaller than the peak, eventually no MBS, and a lot more short-term treasury bills.
That's the picture emerging from the sources for what a normalized balance sheet might look like within this ample reserves framework.
Wow. Okay. We have really covered some ground here, haven't we? We've taken a serious deep dive into this world of quantitative easing and quantitative tightening.
Yeah, we've looked at how the Fed uses these really powerful tools to expand and then contract its balance sheet. Walk through the history in the U.S., the QE 1, 2, 3, the massive pandemic response.
We've dug into the impacts on markets, the economy, even the government's own budget, and the Fed's remittances. It's complicated stuff.
Definitely. And we tackled the challenges, the mechanics of knowing when to stop QT, that whole ample reserves idea, the role of the on-RRP, the risks involved.
And even peered into what the Fed's balance sheet might look like years down the road.
Hopefully this whole journey has given you, the listener, a much clearer sense of what these powerful, sometimes really obscure-sounding tools are all about.
Yeah, maybe phrases like balance sheet runoff or ample reserves feel a bit less like jargon now and more like real concepts with real effects.
It's undeniable that these tools, QE and QT, they were considered so unconventional, so extraordinary just 15 years ago. Now, they seem firmly part of the standard central banking toolkit.
Which really leaves us with a final thought to chew on, doesn't it? Given that these huge balance sheet operations are now basically option B alongside just changing interest rates, how might that change the way the Fed tackles future economic crises or slowdowns?
And what could that mean for the financial world, for economic stability that all of us have to navigate in the years ahead? Something to think about.